Uh, Greetings. Welcome back to the continuing lecture in um, capital structure and leverage. Um, this is Corporate Finance by Dr. Jeff Holm. So, in our last class, we did an example about uh, the effect of leverage, right? And how we can achieve the target earnings per share by altering the leverage, right? And how to solve for that exact uh, uh, debt ratio, right? So it seems like uh, leverage is a very useful tool to increase the company's financial performance. True to some extent, and I've been telling you over and over, leverage is a two-edged sword, right? Because um, this is nothing new. We've been talking about this. It multiplies the good results into great results, but it also multiplies the bad results into terrible results, right? Um, so during the good economy, it improves the performance, right? Increases the ROE, return and earnings per share, but also leverage has the volatility, the variance, right? The risk to the financial performance when operating results change. So effects push stock prices in opposite directions, right? Because, and we saw this already, so it's not really uh, in that, ABC, right? Balloon company example, right? Remember, so back here, right? Look, between 0% debt, this is bad economy case, and the good economy case, right? On the good economy, we have, look, 80% debt, right? Earnings per share can vary between $3.60 and ROE between 36% to 0%, right? And $0 with, very high leverage. 80% is extremely high leverage, right? But, 0% debt, you know, um, very little change, right? I mean, relatively, small change, right? ROE 12% on the good economy, $1.20 earnings per share on the good economy, and 4.8% ROE and 48 cents earnings per share, right? So basically, it's something we already understand, right? Variability is, the variance, right? The incremental difference in ROE due to financial leverage is 28%, 29%, right? Between no and 80% debt, right? On the good economy, even, right? So, so obviously we want to find every investor wants to find the optimal capital structure. Uh, the investor behavior will, how the investors uh, behave differently, right? While we are, trying to locate the optimal, right, capital structure or where that happens. Now, at low debt levels, right, an increase in leverage has a positive effect on investors. Yes, and we've seen that ROC, return on capital employed, right? And with the uh, low levels of debt, right, which means especially with the while the cost of debt is still at tax adjusted cost of debt is still lower than the return on capital employed. There's more room for uh, uh, increased leverage, excuse me. And as with the low, while the debt level is low, right? You can increase debt and still, that will have positive effect on investors. Investors more because return on equity, earnings per share improve, right? And investors more or less ignore. So obviously, when debt level is low or the debt ratio is low, leverage is low, investors ignore the risk effect. But then as the debt ratio increases or leverage increases, of course, risk concerns outweigh, overshadow the benefit of increased performance because, of course, financial distress is increasing. Additional leverage lowers the stock, therefore, additional leverage lowers the stock price because um, why? Because, first of all, they require higher return on the stock, right? To compensate for higher risk, they require higher return. And if the required return is higher, that means discount rate is higher. The valuation goes down, right? Uh, yeah, that's most of you probably thought, oh, because the risk is increasing, they sell the stocks, so the price goes up. Well, that's also true to some extent, but more logical explanation is even if they don't sell the stocks, even if they don't dump the stocks, um, because of the higher discount rate, the valuation goes down. So therefore, as leverage increases from zero to high levels, stock price goes up and reaches a maximum and then drops, right? Maximum stock price, where the maximum stock price is located, that's where the optimal capital structure is. And uh, uh, this symbol, you understand what that is. There exists no practical way to find the optimum, but some conventional wisdom does exist. Well, actually, it says practical way, no practical. But actually, if you are, I mean, this is assuming that the most uh, uh, financial managers are not don't have that much mathematical savvy. But that is ridiculous. If you're a financial manager, that means you must have at least something like a CFA, right? Certified Financial Analyst. With CFA, to have a CFA title, you would have a lot of math background. You would have to be trained extremely uh, uh, in math and statistics, right? So, being a financial manager, you would know how to find uh, optimal capital structure. Um, using, calculus, right? Um, well, anyway, we'll talk about that later. But no, it's not. It's again, it's additional. I mean, in Finance 300, you would learn to eventually, whether you like it or not, you will have to deal with the calculus. Now, however, even though there is no practical way, there is some conventional wisdom. And what's that conventional wisdom? Before we, so the conventional wisdom is okay. So you click on this, and that takes you there. Um, the conventional wisdom is a firm with good profit prospects and little or no debt is probably missing an opportunity by not using borrowed money if interest rates are reasonable. Uh, for most businesses, the optimal capital structure is somewhere between 30% and 50% debt. That's what I've been telling you. 50% is too much, but it's like 30 to 40% debt, right? 30 to 40% debt. Now, debt levels greater than 60% create excessive risk and should be avoided, right? A company with a capital structure with more than 60% debt, very highly uh, risky, right? High risk of very high risk of default. Also called financial distress, right? Now, so this is basically uh, the graph diagram between stock price and optimal capital structure, right? So as the debt level, the horizontal axis is the debt level, or the debt ratio. 0% debt. Obviously, if you extend this curve, stock price would be very low. And as the leverage goes up, stock price goes up, and the stock price reaches the maximum, and that's where the optimal capital structure is found. It looks like it's pretty much, looking at this graph, it looks pretty much like it is towards like 60%. But it's just graph a graphical representation. I mean, uh, it may be, maybe misrepresented, but conventionally, it is found somewhere between 30% to 50% debt, right? 30 to 50. Now, and then after reaching the apex, right, it goes down again. So, how do you solve this? How do you find this point? And using calculus, you can find, because it's the point where the slope of the curve is zero, right? That's the idea of basically calculus, right? Finding the inflection point. So, and this is once again revisiting that uh, formula, right? Um, so target capital structure and effective leverage on stocks, not trading at book value. Now, the example we used, right, in the example we used here, in this, that was example what? Example 14.1. Um, the the stock is trading, right? The assumption was, you can still uh, you can increase the debt uh, uh, without immediately affecting the price of the stock. So the stock will still trade at the book value, and also the cost of debt without also increasing the cost of debt. But what if the stock price changes? Now, think about it. If you're increasing debt, right, because the default risk is increasing, there is no way the stock price would not change, right? We just discussed it. Um, because of added risk, right? The stock price would have to go down, right? Because the required return goes up. So, and that's more, relaxed assumption because reflecting more reality. Previous assumption that stock price doesn't you can increase leverage without affecting the stock price and still, at the same cost of debt. That is very restrictive assumption. So if we relax that assumption, one thing is that the stock price isn't constant, right? Um, you cannot increase leverage without affecting the stock price. So here, a firm's target capital structure is management's estimate for the optimal capital structure. Yes, that's true. Per ROCE analysis, new debt level can be solved for as follows. Yes, from solve this for D, and that's the new debt level, right? And I worked out this formula, right? Which seems quite, complicated. Uh, but you can do that. However, chain leverage involving equity purchase not at book value are more complex. Yes. Uh, repurchase stock at non-book value, right? Uh, so now think about it. You will, because you are substituting, I mean, you are substituting uh, debt for equity, right? Uh, so you will need to reduce the outstanding number of stocks. So you'll have to buy back the stocks, right? You have to repurchase. Um, so if you do that, and with the you buy back the stocks with borrowed money. So that's how you increase the leverage. So it would have the same general impact on ROE, but not necessarily for earnings per share. So because leverage is increasing, ROE is gonna uh, uh, will have a positive effect. ROE is gonna go up, uh, but not necessarily for earnings per share in this case. So let's see. Uh, what that means is uh, if since the stock price is not at book value or it is more at uh, if they buy back at a higher uh, price because buying back because when you are buying back stocks that um, that's like more demand would put an upward pressure on the stock price. So the stock price would then go up, market price of the right market price, and then um, earnings, the same earnings divided by same earnings per share divided by now. Um, so let me come back to this. Let me get back to this later because the thought is just escaped. The thought just escaped me. I was trying, just lost uh, track of what I was trying to say about this. So I will come back to this. Now, so that takes us to the degree of financial leverage, right? We understand what there are two types of leverages: financial leverage and operating leverage. And what is degree of financial leverage then? Financial leverage magnifies change in EBIT into larger change in ROE and earnings per share, EPS, right? Because first of all, uh, because of the tax shelter, right? I mean, the higher leverage would give you, uh, the adjust after, the adjusted uh, cost of debt, right? After tax cost of debt after at for um, tax, right, would give you uh, the positive effect on earnings before interest and taxes, so that change in earnings before interest and taxes will be reflected in larger change in ROE and EPS. So, the degree of financial leverage quantifies the effectiveness of the leverage by relating relative change uh, to EPS and EBT, right? So, degree of financial leverage can be expressed, uh, uh, calculated by two, formulas, right? They basically um, are the same thing, but expressed in a different way. First of all, the idea is very well captured by this formula. What does this formula look like? It's the percentage change in earnings per share over percentage change in EBIT. Now, doesn't this formula seem a little familiar? Percentage change of something or percentage change uh, in something else. What is this? Do you, from microeconomics, I mean, you must have all taken microeconomics, right? Um, and in microeconomics, do you remember something called elasticity? So, what is an elasticity? Elasticity is usually, elasticity, demand elasticity of demand, right? Demand elasticity, uh, uh, price elasticity of demand or income elasticity of demand. So just to recap, let me just stop sharing this and let me use the whiteboard. So where am I? Okay. So let me use the whiteboard. Okay. And okay. What is elasticity? Usually, elasticity is represented by Greek character uh, uh, eta, right? Of course, E for elasticity, right? And it is, percentage change, right? Percentage change in quantity demanded over percentage change in price. So we all understand there is an inverse relationship between quantity demand and price, because obviously if price falls, demand, quantity demanded, increases, and price goes up, quantity demanded will go down. So this ratio will come out, will have to be always negative. But a negative isn't really a negative number. It simply means these two variables are in a reverse relationship, reverse correlation, right? And so let me put it this way. What if the price goes up by 10%, right? Oh, well, we can predict the quantity demanded will fall. But will it fall by 10%? If it falls exactly by 10%, this ratio will be -1. Isn't it right? Because they move in opposite direction, negative. That simply means the direction is opposite. But the magnitude of change in the quantity demanded will be 10%, and which is exactly the same magnitude of change in price. So if the price goes down by 10%, and if the elasticity is 1, -1, that means if the price falls by 10%, demand will increase by 10%. Price goes up by 10%, demand will fall by 10%. Okay, so if this is the correlation simply between the two variables, right? Now, of course, between demand and quantity and price is the independent variable. Demand is, a dependent variable. Quantity demanded is dependent variable. So, if this number, there are three possibilities for this number. It could be greater, less than, or equal to, or less than 1. Okay, here once again, this is -1, but we all know I'm not gonna repeat it over and over. Simply, I don't have to use negative because we are only interested in the magnitude, right, of change. And negative simply means that the direction is opposite, right? So think about it. If this number is 1, this ratio is 1, that means 10% change in price will cause exactly 10% change in quantity demanded. If this number is 2, greater than 1, let's say something like 2 or 3, if it is 3, what does that mean? 10% change in price will cause 30% change in the quantity demanded. For example, 10% drop will cause 30% increase in the quantity demanded. If this ratio is less than 1, like 0.5, it means exactly 10% increase in price will cause a drop in quantity demanded, but 5% the demand goes down by only 5%. So if once again, if this number is greater than 1, then it's called elastic, right? It's relatively more elastic, right? Demand changes elastically, very elastically, like by 30%. When 10%, there's a 10% change in price. And if it is only like something like 0.5, is called relatively inelastic. So if your product has inelastic demand curve, you are more or less in more control over pricing because you can raise price and then demand will drop, but the drop is relatively uh, in small magnitude, right? You can raise price by 10%. You can expect the drop in price only by drop in demand only by 5%. So you can raise price and still, absorb the, and then you can, then calculate the impact on total revenue. And the total revenue drops relatively, less. So the increase in price, the gain in total revenue, uh, um, more than outweighs the drop in total revenue due to uh, you know lower drop in quantity demanded, right? So how do we also how do you find the change in uh, how do you calculate the uh, percentage change, right? Of course, we know it is change in Q over Q, right? Um, and then as change in P over P, right? That is, a percentage change, think about it. If quantity increased from 100 units to 150 units, right? The change is 50 units, right? And then the original quantity was 100, so the percentage change is 50%, right? Makes sense. That's how you do it. And then we can rewrite this as because if I this is changing Q over Q. And dividing something by a fraction is the same thing as multiplying by the reciprocal. I will be multiplying like by P over change in P. Okay. And rearranging the terms, right? It can be like, it can be rewritten as changing Q over change in P, right? Times P over Q, right? Okay, but this is basically price elasticity of demand, right? Of course, there's also income elasticity of demand. We all understand. Then there is a positive correlation. Unlike the price elasticity, income elasticity has a positive correlation. For example, the higher the income, the more the demand. I mean, um, if your income goes up, right? Of course, there's a substitution effect. I mean, if your income doubles, I mean, you can, uh, you've been buying, let's say, just because your income goes up, you don't eat two hamburgers, suddenly. But anyway, uh, you can double your purchase of something when your income goes up, right? If your income doubles, you can purchase double the purchase of the same item if your income doubles. Well, that's usually the case. The correlation coefficient would be positive in case of income elasticity of demand, right? But of course there's substitution effect when your income goes up. Now you will substitute, you will substitute something for something. For example, you were mostly eating hamburger, cheeseburger, for lunch. and your income is doubled. Well, instead of eating two cheeseburgers because suddenly just because your income doubles, you don't double your meal in quantity. Rather, you change the quality. You go up in the quality, right? Instead of eating a cheeseburger, now you can eat steak for your uh, lunch. So this is called a substitution, right? But anyway, forget about the further uh, further uh, expansion of the concept, but let's just limit it to the price elasticity of demand. We see elasticity is simply um, capturing the correlation between the two, right? And these two are correlated as dependent variable and independent variable, right? Price is the independent variable. Quantity demanded is um, dependent variable, and elasticity captures the correlation between the two. And if you think about it, isn't it exactly like that? DFL, what is DFL? Degree of financial leverage is like percentage change in right EPS, right, percentage in earnings per share over percentage change in EBIT. So think about it. By changing the leverage, by increasing the leverage, right, EBIT will change, EBIT will go up, and how much that so how much change in EBIT causes how much change in earnings per share. In other words, the percentage change in EBIT um, the correlation between the change in EBIT and change in earnings per share. I mean, isn't that basically the whole idea? When you increase leverage, right, uh, it will result in higher EBIT, and as it results in higher EBIT, how much of that percentage change in EBIT is translated into percentage change in earnings per share. So it's exactly like the concept of elasticity. In other words, elasticity is, in other words, the sensitivity of response, right, responsiveness of one variable to another variable. Usually, that output, how sensitively does the output respond or react to the change in input, right? So you can consider this as input output ratio and sensitivity between the input and output, right? So same concept. So the higher the uh, but unlike the elasticity, the algebraic sign won't be negative. It will be positive because obviously more EBIT, uh, the greater the EBIT, the greater the earnings per share, right? So uh, you can also say what kind of multiplier effect does financial leverage bring to uh, EPS. I mean, it will higher financial leverage will have a multiplier effect, and it will increase EBIT, and it will increase earnings per share as well. So there's a multiplier effect going on. So this is, basically, uh, uh, you know, think about it. If this uh, ratio is, once again, you can have three possible ranges of values, right? Greater than 1, equal to 1, or less than 1. So if this ratio is, greater than 1, uh, something like 3, what does that mean? 1% change in 1% increase in EBIT will cause 3% increase in earnings per share. And you might say, wow, that's wonderful. But then think about it. Sorry, I said this won't have negative. Algebraic sign won't be negative. It'll just be positive, or 1, or between 0 and 1, right? It can be between 0 and 1 also. That also means, if this ratio is 3, that also means, when in the bad economy, right, EBIT would go down. And if this ratio is 3, 1% drop in EBIT will cause 3% drop in earnings per share, right? Two-edged sword, right? Two-edged sword, right? And as I said, I gave you an example of margin trading, right? During, if you have a, lucky streak, right? If you have a streak of luck, then, the margin trading, trading with borrowed money would result in a higher return for you, even after paying back the borrowed money with interest. But if you run out of that lucky streak, then it's going to be a horrible, horrible disaster, because you lose, like, 100%. Still, you have borrowed money that you still have to pay back with interest. This is going to be a hell, right? So let me do what? Let me stop. Let me go back to PowerPoint. Okay, so this is why, what degree of financial leverage is about. And this is most common way of, because it's like elasticity, most common formula. But also you can calculate FL this way as well. It's EBIT over EBIT minus interest. Now, EBIT minus interest is what? Oh, of course, that's EBT. This is the ratio between EBIT and EBT, right? Isn't it right? So ratio between EBIT and EBT. So think about it. EBIT, the ratio between EBIT and EBT is, what does that imply? I mean, what does that mean? It is the function of how much power the financial leverage has. right? Um, if you have a lot of leverage, right, interest will be a lot. So the difference between EBIT and EBT will be huge, and the ratio will be high. Make sense? But if your financial leverage is low, then interest will be low. The difference between EBT, EBIT and EBT won't be that much, and the ratio will be small. Once again, the higher this number, right, more that means more volatile, right? The the more elastic, right? The more elastic the demand, right, to price, then a small change in the higher elasticity will cause. I mean, with a higher elasticity, small change in the price will cause huge change in quantity demanded. And you might think, oh, that must be a good thing because we dropped the price a little, then the demand will increase, hugely, right? But the opposite is also true. You raise the price just a little, there will be a huge demand in quantity demanded. I mean, huge drop in quantity demanded, huge drop. So that would make your outcome very volatile, right? So let me go to an example of degree of uh, financial leverage. So selected income statement and capital info for Mobley Manufacturing Corporation is as follows, and everything is in thousands of dollars, right? So income statement data and capital info, that's basically a balance sheet data. So this is income statement, right? Revenue, cost, sold income statement, EBIT income statement. Debt and equity, balance sheet. Uh, Balance sheet data, right? So this company has, revenue of 5,580,000. So 5 million, 5.58 million. Cost 4.2 million. EBIT 1.38 million. Capital equity and debt and equity are like this. Total capital is 8 million. And then currently 700,000 shares of common stock are outstanding. So number of shares outstanding. Firms pay 15% cost of debt on its debt, right? And anticipates to borrow as much as reasonably needs at that rate. In other words, um, this is also a very restrictive assumption, right? Your cost of debt cannot stay constant because if you increase borrowing, cost of debt would have to go up. The more you borrow, right, uh, the higher interest you will have to pay. Uh, but with this restrictive assumption, we assume you can borrow without cost of debt will remain constant, and you can borrow as much. So this is, again, restrictive assumption and anticipates to borrow, yeah. And the firm's corporate tax rate is 40%. So what does that mean? You will need to calculate the after-tax adjusted cost of debt, right? Tax adjusted, right? Cost of debt, or after-tax cost of debt, which is cost of debt times 1 minus tax rate, right? So that will be 60% on this. Mobley wants to boost its stock price. Yeah, to boost stock price, what do they have to do? They will increase leverage. In other words, they will borrow money. In other words, like sell bonds, and with the proceeds, you buy back your own stocks, so that the leverage would go up without changing the total capital. You simply rebalance the capital structure, right? Rebalance the capital structure, right? And by doing that, you can increase the earnings per share, right? And ROE. Um, so as earnings per share and ROE go up, it will have a positive effect on price. However, the economic outlook is shaky, and the firm CFO thinks, there is a good chance that EBT will drop next year. At the moment, Mobily's stock sells for its book value of $10 per share. Estimate the effect of the proposed restructuring on earnings per share. Then use DFL to assess the increase in risk. Risk is what? The variance, the volatility, the variability in return, right? That'll come along with it. So let's take a look at this before and after picture. Since the equity is trading at book value, this is relatively a simple example. So first, this is the current capital and structure and proposed, capital structure. Currently, it is, right? In terms of, capital structure, it's, 1/8, 7 over, debt is 1/8. In percentage, that would be what? It's greater than 10%, but less than maybe 16%. And then equity, 7/8. 7/8 is in terms of percentage, right? But we know, we don't have to turn it into percentage. It's obvious. 1/8 is debt. 7/8 is equity, right? Yeah, 12.5% is debt, and means 87.5% is equity. But they want to turn it into 50% debt, 50% equity, right? And then to achieve that, right, they will have to reduce they will have to buy back shares and and reduce it to 400,000 shares. Well, how do we know? Well, the book value, the stock is trading at book value of $10, right? And for equity to be 4 million, right? Everything is in thousand. For equity to be 4 million, right? $410 divided by 4 million, 400,000 shares. It was previous 700,000 shares. Now, oops. EBIT currently 1.38 million, right? Proposed 1.38 million, right? There's a chance it would go down, but hopefully it's not. It will, we assume, it will hold, same EBIT. Now the interest previously at 50% debt ratio. At 50% cost of debt, right? 50% interest, 15% interest rate. 15% times this will be 150,000. But after restructuring, after rebalancing, structuring, 15% times this 4 million is going to be 600,000, and the EBT will be smaller because you are subtracting more taxes, right? I mean, subtracting more interest. So EBT will be smaller. And at 40% tax rate, 40% of that will be this 1.23 million. 40% of 1.23 million will be for almost $500,000, but 40% of 780 million is this. So EAT will be 738. EAT will be 468 in this case. But if we calculate earnings per share, right, divide this by number of shares, right? Divide this by number of shares. It is just $1.05. But you divide this by number of shares, $1.17, right? You achieve higher earnings per share. If business conditions remain unchanged, if business conditions remain unchanged, in other words, still same EBT, right? Higher earnings per share will with the addition of debt. Yes, we understand that. Right? And then how do we calculate the degree of financial leverage? What is that? EBT over, EBIT over EBIT minus interest. So EBIT over EBT, right? Currently, it is 1.12. Proposed with the proposed restructuring or proposed capital structure, right? It will be EBIT over EBT, and the ratio increases. In other words, the just like elasticity, right? The sensitivity, right? Sensitivity is also volatility. If you think about it, if something is sensitive, you just touch it, it just goes volatile. You touch it, it goes. Like a balloon. You touch the balloon, it just bounces. Quickly, and a big distance, moves big distance. But you touch a bowling ball. What happens? Try. Oh, of course, bowling ball is a ball. It will still roll, even by a slight touch. But something heavy, you touch it, it doesn't go off, right? But a balloon, you touch it, it just flies away. That's how volatile it is, or how sensitive it is. So degree of financial leverage, increased degree of financial leverage means, the result, the performance of the financial performance or the financial result of this company will be more volatile, right? Earnings per share will be much more volatile under the proposed plan. Earnings per share will change by a factor of 1.77 versus 1.12. Okay, so this is the meaning of degree of financial leverage. Once again, it's like elasticity, and if you think about it, beta is also about the correlation, right? A higher beta means a more volatile asset, more volatile stock, and a lot of things we measure the sensitivity, right, or the elasticity, right? So that's it for today, and we'll continue with the next example in the next class. Okay. So thanks for watching. I'll see you guys in the next class. End of video.